What's going on, guys? Good morning. Welcome back to another live stream here with the Everyday Growth Advisors. Just wanted to stop by and give you guys a little bit of direction for FOMC day today, and kind of talk about what happened yesterday. There was unfortunately a little bit of a sell-off with some regional bank fears. We saw a pretty big sell-off in KRE, which was the regional banking ETF. This ETF has been seeing significant outflows already, and yesterday saw a little bit more. Just from a technical outlook, it does look like it has a little bit further down to go, and financials have been pretty weak this entire week, or this entire couple of months, and unable to kind of recover fully. But I think that it's been a nice little cushion for the market to pull back as well after a little bit of this gamma squeeze from last week. Was it a perfectly timed and orchestrated pull or rug pull down to create some liquidity ahead of FOMC, or was this a legitimate concern of the market? That's something that we will have to see how it plays out. There has been very interesting developments in the market in the past weeks, because we've seen a range of defensive sectors, mainly like, for example, utilities, right? Being one of the sectors. We have seen sectors such as consumer staples, for example. We have seen sectors such as healthcare, for example. All these sectors have been kind of bullish, and we call these defensive sectors because they are typically sectors that will do well in a uncertain market. We've been seeing a lot of the money moving around from these sectors that have been overbought, such as semiconductors. and kind of flowing into all of these defensive sectors in the past couple of weeks. So more on that a little later, but technology has been seeing a little bit of outflows based on what we've been seeing, with the exception of last week's short squeeze. So this is something that is still kind of a developing sector rotation, and I think we've kind of been like generally more positive on tech this year because we had the in the beginning of the year through our newsletter we did mention that mainly we want to go long bonds, and then after that we want to go long equities second half of the year, which is where we're going to start to approach this right now. And we've really started to position ourselves for that equity placement, well ahead a couple months prior. Of course, there's no way to time this market perfectly, but we've been trying to kind of pick up these pieces of equity as the market kind of goes up. Now, don't forget something: the U.S. Economy is in a recession right now, and many people don't really know this. The recession has already hit us. It's been here for like a couple of months already, and the market is already fully priced in this fact for a long period of time. Okay. What's to come from here is the market's perception of what the next 6 to 8 months is going to be like, right? And I think that right now, many cyclical and value plays are losing momentum, right? Among things like mining, autos, retail, construction, semis, right? All of those are all your cyclicals, and they're joining the banks, which are also cyclical, on their weaker run for this year. So I think this rotation will continue, and we'll see if the Fed hike will also add a unique dynamic edge to this, of course, in due time. So I think that's something that will be interesting. Now, with the S&P 500 where we are right now, kind of forming like a weird megaphone pattern, which this is purely for entertainment purpose, which I'm drawing it for. This is very unlikely to play out the way that I've drawn it. But if we do get that move way below 40.60 and we start rejecting 40.60, then that's going to be a key pivot. Below 4100 allows us to get to 40.60. So today's FOMC, remember, just general guidelines once again. Please, don't do anything when the rate decision comes out. What's baked in? 25 basis point rate hike today. I think the federal funds market has priced in a 90% likelihood that happens. It's close to 90%. I believe it's 86% right now. So the market's really going to be focused on the presser, which is the press conference with Jerome Powell. And it's really going to be looking for just some leading information on the next moves from the Fed. And it's very unlikely that he takes a dovish tone today. So if any kind of dovish tone is heard from Powell, that will be a very interesting development. So they will release their interest rate decision at about, I think, 2 p.m. and then the press conference at 2:30 as usual, right? And what we're likely to see is Powell come on and kind of say the same things he said before, and possibly signal that there are more rate hikes on the table. Now, the market is probably already expecting this, so it's somewhat priced in. That means for June, we get another rate hike. I think it's 50% priced in, possibly. So it wouldn't be like a super shock, but it will be, obviously, like the market's not going to like it, okay? That's going to probably send us down very minutely. So the highest possible scenario here in terms of percentage-wise, there's two of them. And I posted this on the Discord already, so I'm just going to share it with you guys. This is from JP Morgan. So let me just share with you guys the playbook for today. 1 second. Where is it? Also, if you're in our free Telegram group, I posted it there as well. So you have it here. So less than a 1% chance of a rate cut, obviously. 5% chance of a no hike and pause scenario. Which means just no further rate hikes. And then a 55% chance, this is the highest percentage chance, of a hike and a pause. And this is what majority of the market is pricing in, with a 92% chance of hike as of April 28th. Here, the Fed would be relying on a tightening of lending standards stemming from the banking crisis to act as de facto rate hikes. Any language that the market interprets as the Fed being on pause should benefit stocks. So that will be one of the main things the market's going to be looking for. This outcome is not fully priced into equities. We think you could see the SPX adds about 0.5% to 1% on the day. So if they decide to say hike and pause. If hike and continue, this is the other likely scenario. Then this is another likely high probability outcome, which is pretty much data dependent. I expect Powell to say something like, we will continue to need to see the data, yada, yada, yada. Like how he always says it, right? Powell's a good a guy who knows how to use his mouthpiece. So I fully expect him to say something like that, where he goes like, okay, we need to see where the outcome of the data is going to be like in, April for us to make a decision. Okay. And you'll see he'll probably talk about the CPI print. Now, remember one thing. I have to say this very important thing. The Fed is no longer going to actually focus a lot of their decision making on PCE or CPI. Okay? This is going to become less and less reliable as a piece of indicating information for inflation. What they're going to start focusing on is, what do you guys think? Does anybody know what the Fed is going to start focusing on? Because that's going to be a more telltale indicator. And Powell spoke about this in the previous meeting too, right? Where a bunch of senators questioned him about it, right? If you guys remember, he's going to actually focus on labor, okay? Labor. The labor market. This is what we really want to see. Yes, jobs data. That's right. Hey, what's up, Saul? What's up, Shuri? Mark, thanks for being here. So yes, the most important thing that the Fed is going to focus on right now is labor data, okay? And once we start to see that unemployment rate starts to tick up a little bit, which, by the way, we're seeing a little bit of this happen right now, that is going to be a good sign that inflation is actually going away slowly, right? Remember that one of the byproducts of inflation going down is where a bunch of the economic activity is somewhat destroyed. And yes, this is a negative trade-off. It is what it is. Like, this is what what happens when the Fed has to do its job, okay? And a lot of people might throw shit at them, and they might say like, oh, you guys suck for doing this, but this is how it's always been. Every single chair has had to come into the Fed and make these tough decisions, and it is exactly what it is. There is literally no other way around it, okay? Because when you decide to raise interest rates in a economic environment when the economy is slowing down, we have stagflation, which, by the way, we spoke about on this live stream many years ago. I think 1 or 2 years ago is when we mentioned that stagflation is going to be like part of our our working thesis of how this economy is going to go, right? If you scroll down our live streams, you'll be able to see a couple of years back is where we already predicted this. Part of stagflation is the fact that jobs will get destroyed, okay? Because the economy slows down, spending starts to slow down a little bit, and part of that process is consumer demand slows down, and then when consumer demand slows down, jobs get destroyed, okay? So that's going to be part of it. So I just wanted to kind of give you guys some cliff notes or some spark notes for the Fed and how to prepare yourself for today. Now let's look at technical wise. SPX somewhat has been following this, but obviously remember I drew this yellow arrow as a joke and just to mess with you guys and kind of give you guys a bit of entertainment, but actually it played out pretty nicely, right? So if you look at just how the price action's gone so far, we had this little wave down, wave up, wave down, and then a huge squeeze, and now we're getting that wave down, and then potentially a huge squeeze to the upside again. We did see a little bit of a market maker activity being really sus yesterday. They were buying a lot of this dip yesterday, which was being sold into. So I wouldn't be surprised if they try to rip it to the upside at some point of time within the next 1 to 2 days. By the way, if you guys are listening in and you truly enjoyed this live stream and everything that we do here, I would truly appreciate it if you take a second out of your day to smash the like button for me. That's really the only thing that I ask if you do attend these streams and you feel like you're prepped enough, or if you want to post your comments, your ticker symbols that you want me to break down, or anything like that. I just appreciate you just hitting the like button so that the YouTube algorithm can do its thing. That's the most helpful thing for us at EGA, so that this stream can reach more people and more people can learn and it can grow with us. Okay, so going back to this SPX trade, right? And rather the SPX analysis here. You know, if we got this 4100 bounce yesterday and we aren't able to come back down here to retest this level or at least bounce on this level, then you know it brings back 4180, which has been the key pivot, back on the table again, right? And you realize above this level here, there's really not many key pivots. There's like literally one around 4218, but it's not a very strong one. Above this is really only 4300, like way up here, okay? And so 4300 will be the next, actually 4310, right, roughly, will be the next key level here on SPX for the upside. This is the reason why I think this path forward for a squeeze to the upside at some point in time is the most likely path, because it will also be the max pain path for a lot of people who are trying to short this market continuously. Although I would like a nice little dip for us to buy so that we can take this up, you know, in the second half of the year. NASDAQ seems to be in a very similar predicament here, but a much more simpler chart and a much more simpler understanding here that we had a strong bounce. Even yesterday's dip was pretty small on NASDAQ. Tech stocks didn't obviously get hit by that regional bank data yesterday. And so we still see continued buying in tech, active buying in tech, which is the biggest sector of the S&P 500. We continue to see this as a strong secular trend that people are still kind of saturating in terms of upside exposure. Now, many months back, if you guys realize, when NASDAQ was down here and down here, I told you guys that people will scramble for exposure in the market as soon as these big waves happen. And now, that is exactly happening. And just about a week or two ago, I told you guys smart money was dumping ahead of retail. We got that little bit of a pullback, but you know what? It wasn't enough of a pullback. So the thing is, we are still waiting for that shakeout. The shakeout has not happened, and I think FOMC could be a potential trigger for the shakeout. Okay, it could be a potential trigger for the shakeout. This is the reason why I say today, my recommendation to you is to sit out. Don't trade this market. Okay. You're gonna get yourself into you're gonna get your panties in a bunch if you try to trade the market today. You might get yourself into trouble. So I don't recommend doing that. But you know, as I said, so NASDAQ has this little push to make up here. This is a key pivot point, 13,561-ish. And this is a key level pivot for NASDAQ to go up and retest at some point. And if it does get up here, then you know it could even break higher. And if NASDAQ leads this rally, then ooh, hallelujah. You know, we could get up all the way back into 15,000 or so and so forth, and break out of this downtrend and sideways movement that we've been having for years now, right? 1 year, more than a year, right? 1 year and a couple months, okay? So, 1 year and 5 months to be precise. Yeah, 1 year and 5 months. Downtrend plus the recovery here, right? So that's where I see things with both of these indices. Now, IWM still, as I mentioned, this one's not going to recover until monetary policy starts to loosen, or perception of monetary policy starts to get better. In other words, financial conditions need to get better, right? And before that happens, we won't see this sector recover. So we'll be keeping our eyes on it. Of course, if it comes down to 169 the next time it does, I feel like I might take a small bullish bet on that one. The VIX did a little bit of a dance yesterday. Went up all the way about 20-some% before falling back down to 1792 again. It has been kind of dancing around a little bit, which shows, you know, market participants are actively hedging, but also very quickly taking off their hedges. They're not holding those hedges for a long time. So they're hedging into the downward movement, into the fear and the panic, and then once that downward movement is happening, they're covering that hedges, which is kind of precisely what we did yesterday. So we caught that whole move down, right? I took a SPX hedge like literally 6 minutes after the market opened, and made like a little nice 127% on those after the market fell like crazy yesterday. You know, obviously these were the runners, but yeah, those contracts went from 1170 all the way to $29. It was a really nice trade. Obviously the small account also ate a little bit, a little smaller because I just took 4 contracts. But yeah, this was a great one. Also took a little bit over 51% on the small account, because you know you gotta take a little bit more profits on the small account more consistently, just to kind of have that consistency going. Now, adding on to this, you can look at the U.S. 10-year yield. You know, has been kind of crashing here a little bit, right? The yield. So if the yield's crashing, that means the bond prices are increasing, and people are starting to slowly start buying bonds again, potentially, but nothing significant just yet, guys. Here, there is no development in the bond market so far. We've just been ranging sideways. So until we really break below this 3.3% or 3.2% yield on the 10-year, I don't think there's much of a development here. Same thing goes for the 20-year and 30-year. We do want to see these improve though, and we want to see the yields of these start to kind of flatten out a little bit. Especially we want to see the yields of the 1 month, 2 month, 3 month, 6 month, 1 year. All of these, we want them to smash downwards, right? We want people to start getting optimistic about bonds again in the short term. And that's the reason why nobody wants to hold these right now. That's the reason why the yield is so high. Everybody's selling these bonds, right? So that's where the bond market's at. We will obviously continue to monitor this data and kind of tell you when something significant has happened. But right now, I don't see much activity here that I need to report back to you guys just yet. I think it's still kind of sluggish. The interesting development is in the dollar index, right? We tried to break out here a couple of times in the past, I want to say weeks, right? And dollar index has been trading flat, but suddenly yesterday, after spiking on that move down, it kind of has been selling off. So short dollar has been a common theme among many investors globally. And that's good. That's good for U.S. equities, right? That's good for U.S. equities. So we hope that, that continues. We hope that continues. Apart from that, yeah, that's all I have for you guys in terms of the macro structure of the market. There's not really much there apart from that. Tesla, we saw some bearish flow yesterday. It was pretty interesting, I'm not gonna lie. I'll just show you really quickly. This was from our Discord flow that we have. So we did see some 152 strikes. This is from our flow channel, Golden Flow. And we did see some 152 strikes 17 days out. Bought at around 161 spot. Tesla was trading a bit lower after that, so about 1.1 million in premium, which was significant. But then we also did see some QQQ calls come in 17 days to expiry. So we are not really exactly sure if these were put in by the same person, because this could be a hedge directly for this position, right? And this was about $1 million for a pretty out the money strike as well. You can see the spot was around 318 or so, and the strike that they purchased was 327 for the same expiry. So that's an interesting development as well. Then you have some meta puts that came in, XOP puts, more meta puts here, QQQ calls, and then SPY puts as well. These SPY puts look like hedges to me. 79 days to expiry. This one looks pretty out the money to me. And then this with 9 days to expire at 301 looks like a temporary short bet for FOMC. So remember, with flow, you can't really tell what exactly is going on, but you have to make an educated guess based on the information that you're looking at. So just wanted to point those out to you guys. Significant flow that we've been watching in the Discord, and that will be something that we'll continue to watch. Costco still kind of broke out, came back into this wedge, still watching this one. Goldman Sachs sold off pretty aggressively yesterday and then came back strongly this morning. This was a nice little dip buy. I think JP Morgan and Goldman Sachs, they were both pretty decent trades as of yesterday. Then you have Amazon. In fact, you know what? JP Morgan might be the one to play today. A lot of the assumption is going to be that regional banks that are failing or have failed, their funds are going to go to JP Morgan. But this time, I guess people are also thinking it might go to Goldman Sachs, so let's see. Amazon, one of my top watches for today. Consumer discretionary has been a sector, I've spoken about this multiple times, on the verge of breakout, but has not been able to do it. So Tesla and Amazon, these two are in the same boat right here. sitting at some key pivots. Amazon a better structure really. A break up here could send this up into a little bit of a violent move. So you gotta look at this and see how this goes today with the momentum and volume. It might be a bit tough to trade it on an FOMC day, but it was very relatively strong to the market yesterday. This is something I really did like about Amazon yesterday. It was green while the rest of the market was red. You can see that very obviously. So with Tesla, I did mention already, I showed you guys the 152 puts that they bought. So they're betting on this little small move down, potentially seeing Tesla ranging sideways in this short term. But once again, don't look at the flow as the truth or the gospel truth. But obviously this is a very possible scenario for Tesla. Sideways movement here, trapping both bulls and bears, left, right, center. If you're gonna play this, either play it at the 151 pivot, 152 pivot, or at the 166 rejection, right? So don't play it in between. You get yourself caught in a mess. The premiums will just drain you. The movement will not be enough for you to make a bang for your buck. This is my biggest piece of advice for you with Tesla. Do not trade it within this range. You will just put yourself into a very terrible spell, because this amount of movement from here to here, to here, to here, to here, to here, to here is not enough to make you some money. It might be very suppressed premium, okay? NVDA was down pretty significantly, and then AMD also, I believe, was down significantly this morning. Semiconductors continue to be weak as a sector, and we have already mentioned this a couple weeks back. This is almost a 4-week running theme now that semis have been weak. I think that if it continues to be weak, we might see some opportunities to short. With AMD below 83.64 at the market open, I want to see it go back up a little bit, into this, what is this level here? 88, or let's just even call it 86, right? 86, 87. Let's have it go back and back test and reject a little bit. This is a pretty big gap down though. Was this earnings driven? I'm guessing it was earnings driven. Yeah, so it could have, yeah, it probably was earnings driven. Yes, it was. Yeah, 2nd May, correct. So this is earnings driven. And we want to see this kind of move further up here to reject further so that we can take it to the downside. Just a general rule of thumb, guys, for stocks that have, just posted earnings, you don't want to typically trade them on the day after earnings. Let supply and demand play out a little bit, right? You don't have any definitive reason to take the short, and you don't have a definitive reason to go long here. Not to mention the risk-reward ratio here is a little wonky. I think I would be more of the ability to argue here that the short is a better trade if we can get a pullback rather than the long. The risk-reward ratio is better on the downside. Then I wanted to also talk about China ADRs. This is another move in the market lately that no one has been able to kind of understand, and I think I'm starting to understand what has been going on with this. I have been a little bit, obviously, kind of out of it with the ADRs. I haven't really been following Chinese equities for a while. But, a lot of pain has been felt in the Chinese ADR world because global markets kind of have reopened, and now there's kind of a delayed reaction to weaker economic data from China, then increased data restrictions, broader concerns about decoupling between U.S. and China. This is all largely being reflected in the price action of BABA and your TSM and your other Chinese tech here, which have been getting decimated, right? They've been getting decimated. So that's all I have for you guys today. I hope you guys have a good trading session. And I like to keep these as short as possible, but today's a pretty long session. Sorry that it was long. I hope that you found this helpful. If you can, once again, smash the like button if you can. And yeah, I appreciate you guys being here. Take care, have a good one, and we'll see you on Friday. Actually, wait, hold on. Friday I might not be here, guys. Friday I might not be here. Just giving you guys a heads up. What I'm going to do instead is upload a recorded session. So look out for that. I'll post it on Discord. I'll post it on Telegram. I'll post it on socials. You'll be able to watch the recorded session of pre-market live. I'm going to record it before I leave my place because on Friday I have a dinner to attend. It's an important one. So I will record the session before I leave, just so I can kind of get that to you guys and you won't miss the pre-market session. So Friday you'll have a recording to watch, and I'll post it everywhere. Okie dokie. Have a good one. Take care. Peace. Love you all. Bye-bye.